So I appreciate you taking the time to join me today on this. The title of the session is Business Valuation and Divorce. When do you need one and how do you decide? Let's make this easier. I put this together because after doing this work for a lot of years, I noticed that in some cases, folks went ahead and hired an expert or a consultant and spent a lot of money, and maybe it wasn't necessarily needed, maybe certainly not at the level that they spent the money at. Or in some cases, they didn't spend the money and maybe they should have because they left a lot of money on the table in the divorce. That was the reasoning behind why I put this together, to get the attorney and their client on the right path and using a simple process that I created based on things that basically like landmines that people stepped on over the years, mistakes that were made, quite frankly, mistakes that I made over the years, some things that I went, okay, I probably should have asked that up front. So creating this framework for getting to a good result for your client and getting the best return on investment. If you, in fact, even need an expert or a consultant, a financial expert or consultant to help you with this. My bio here, I've been a CPA for a long time, about 25 years. And I started this business valuation practice in 2016. And I focus primarily on litigation, divorce, estate and gift, and mergers and acquisitions. So basically private buys and sells of companies. That's really the only three areas that I practice in. And I refer out a lot of other business valuations to other colleagues across the country that I have contacts with. I served on the NACVA standards board, so there is a little bit of business valuation standards in here, just a touch. And I currently teach on the current update and valuations faculty for NACVA. I've done everything from work for a small CPA sole practitioner to work as a controller in an international company. So I've done a lot of different things. Most of my time has been spent in CPA firms and or tax work prior to starting my practice, about 15 of those 25 years. What you're going to learn today are the questions to ask to get on the right path. And I've got an easy to use decision tree on that. You may find that you have more options than you think in this area. What I'm going to do is show you how to balance the risk of time and the cost of an expert or a consultant with the risk of over or undervaluing a marital asset. What can definitely be true is the business may be the largest marital asset, or it may be worth nothing. And so how do you know? How do you navigate that without spending money unnecessarily? So I'm going to show you how to estimate a return on investment for an expert. It's not guaranteed. Nothing in life is guaranteed, but it's a way to estimate that if you are the hiring attorney. I've got a one-page process that should work for most of your clients. I'm going to show you why understanding business cash flow is critical. Risks of calculation reports. I'll do an explanation if you don't know what a calculation report is, what that is, why I see some serious risk there, particularly in testimony, when to consider settling on the value of the business and when to consider not settling on the value of the business. So I'm going to go through this decision tree, and the way this works is I've got a yes and a no. If we're answering yes, we're going down the right side of the decision tree on to the next page. Okay. No, we're going to stop and consider whether we want to stop our process, ask some more questions, find out more information from the client, request more data, etc. Okay, so that's how this works. It's pretty simple. So the first question that I find is the most important to start with, kind of sets the baseline for how we're going to proceed, is, are we going to use the financial records from the business as is, or are we going to create those using some kind of a forensic accounting engagement. What I would suggest that most of the time you start by going down the right side. We're going to request the documents, the tax returns, the financial statements from the owner or the outside CPA. Get those. I like secure online portals, and I set those up for my clients. I can securely transmit information between myself and the attorney. Email is not secure, certainly as secure as this. And once we begin that exchange of financial records, we can start to have conversations about where to go next. If in some cases you're dealing with a business that hasn't filed tax returns or just is overall extremely messy, just don't have the financial records, there may be the need to use some kind of forensic accounting to create financial statements, possibly over multiple years. And this is typically a separate engagement. And so the client needs to understand that more cost potentially, how to balance that. And that's beyond the scope of today. I'm not going to talk about forensic accounting, but I just want to plant that seed in your mind and let you understand that if it's a real mess, kind of like this picture indicates, and you don't have tax returns, it's going to be a lot more involved. And so the other thing I wanted to mention is you can revisit this later. In some cases, I ran into this in a divorce that went on for a long period of time, unfortunately, largely because of this issue, because I got the tax returns, but there was a lot of messiness in the returns that were filed. And so I ended up having to get general ledger detail to clean it up. From that, I could make the adjustments needed. So we were starting from filed tax returns, but in essence, I was employing some forensic accounting procedures to get the data cleaned up. So again, we're going down the right side. We're saying we're going to use the records as is. And then what? What should we ask next? This is one I think gets overlooked a lot. And there isn't a bright line test for this, but is it a business or a job? And this has come up too when attorneys have sent me information, spoken to me on the phone. A job isn't an asset. And a couple of examples that I came up with, one of which was a real life example, was the in-home daycare. You take that person out, you sell the house or something. There's probably not a business there. Is somebody going to move into that house and run that daycare? Is that something that's really a business, or is it a job? I'd say in the instance that I ran into, that was more of a job than a business. A one-person lawn mowing business. It's a little bit counterintuitive because it's not really a business potentially, because you take that person out, it's really more of a job. Can it run without the owner? Could it be sold? What are the annual sales? I do caution you on that one because I have seen businesses, companies that had $500,000, $600,000, $700,000 a year in sales and were extremely profitable, and they had employees, and they were arguably a business. And I've seen some that had $2, $3, $4 million a year in sales, and they were losing money hand over fist, which is going to kind of get us on to the next slide in that last one about making money. Once we cross this hurdle, after we've looked at the records, had some discussions, we say, okay, we think this is a business. Then what? What next question should we ask? Can it generate cash flow? Very important question. While this is not sorcery, the thing to understand is that cash flow is not on the tax return. There's no line item on the tax return for cash flow. And so there needs to be a little bit of financial know-how to figure out how to calculate historical cash flow, and more importantly, what is the future-looking cash flow for purposes of valuing the business, potentially. You can't just thumb through a tax return and find cash flow. It's the interaction of the P&L or income statement and the balance sheet. I'm going to go through an example later. We're not going to do a deep dive into the math, so don't worry about that today. Very little math in this presentation. But once we've looked at this and said, okay, we're going down the left side in this case, and we say, okay, there's no cash flow. We can see that there's no cash flow or potential for this business to generate cash flow. Simplifying this, I'm mostly referring to, just to simplify the discussion, we're talking about a controlling interest in this company. So your client or the spouse on the other side has full ownership of it. So just to keep this simple. And so they could move the levers on particularly expenses to change those if they wanted to. So we say, okay, it doesn't appear as though this thing has or could generate cash flow. We're going down to this section where it says, are the assets greater than the liabilities? If the answer is yes, even though it generates no cash flow, I often refer to these as worth dead more than alive businesses. So they have the ability, if you were to essentially fire sale them, put them on the market and just liquidate them, there would be some value there. But as an ongoing business operation, what we call a going concern, there isn't really any value to the cash flow piece, but there is value potentially. Asset holding companies are big in my area. These are different than operating companies. Typically, operating companies like a construction company or a dental practice or an advertising agency or a plumbing company or something like that. Those are typically operating companies. An asset holding company could hold commercial property, farmland, residential real estate. I even had one that had all that plus a billboard that they were renting out. So they tend to have a lot of assets in them that may need to be valued through appraisals. That's an asset holding company. And in some cases, you really need to look at the balance sheet of the company and figure out, does it have appreciating assets in it? People stick some strange things in businesses, vacation homes, stocks and bonds, stuff that from a tax standpoint, they shouldn't do, but they do it anyway. And so in that case, you've still got some value on the balance sheet in terms of assets potentially exceeding liabilities, but maybe it doesn't generate cash flow in some cases. Asset holding companies are kind of in a sort of a category by themselves in terms of the way they're typically handled. If we're going down and the assets liabilities aren't greater than the liabilities, this very well may be a company that has no value, no cash flow, no assets greater than liabilities, no value. Once we cross this, we're going to ask the next important question, which is, are we going to need expert testimony or not? And this is the attorney's call, of course. The way that I approach this is in terms of a report. And there are two primary types of reports. There are calculations of value and there are conclusions of value. A conclusion is a very detailed process. I'm going to be doing financial analysis, industry analysis, economic analysis, risk analysis, looking at all three approaches to value and at least one method underneath each of the approaches, reconciling those, writing the story of the company and saying, okay, this is my story of the company. We do have the litigation reporting exception available to us. So in some cases, it may be a smaller report, less narrative data. But the important thing to understand is all that information I just said in terms of the development has to be done in the work papers, because somebody could subpoena my file. And if they saw that I didn't do that information, they could say, hey, you didn't do a conclusion of value at all here. You did something less than that. So that's an unlimited scope engagement. A calculation, on the other hand, is a limited scope report. We're going to agree to certain approaches and methods. And I'm going to dig down into this a little bit later. It's step down. That's a non-technical term. I'm not going to testify to this. The goal is negotiation and settlement with a calculation report. Now, there's less time and cost involved typically, but I'm not going to turn over every rock. So I'm not going to do a management interview, a detailed risk analysis. And what I want to stress here is that calculations can be extremely beneficial in settlement, but we have to be careful with them because we don't want them to get sucked in through discovery later. Okay, so what I suggest is that's handled on the laptop in the attorney's office or Zoom screen share. So the attorney has said, okay, I want a conclusion of value because I'm going to need your expert testimony. You're testifying. And then what? And these slides are interrelated. It's kind of a sort of a tug and pull here. Can a conclusion be done before trial? Very important question. Because if it's just a couple of weeks away, it's going to be difficult to pull off, at least in my case. I might be able to do it in a couple of weeks, but I definitely have to have all the information. And I might have to set everything aside that I'm working on. And so at that point, you as the attorney or other expert involved, the consultant in the case may go, well, maybe we need to consider settlement instead. And so we're going down the other side and we're looking at a calculation report, negotiation to try to get this case settled, because it's going to take a heck of a lot more time to do a conclusion for the reasons I outlined earlier in terms of the time involved to do all that analytical, ask all those questions. I like to interview management and ownership, which may be one and the same in some cases, if at all possible. I may not get access, but I'm going to ask. I'm going to try. And of course, we want to do trial prep too, right? Make sure that we're prepared. I'm prepared for the questions that are going to come as much as I can be. A quick little story. This was a shareholder dispute case. Don't assume that you can't get access to management of the company. Both myself and the expert on the other side in an arbitration, we both had access to management. They didn't take advantage of it. They avoided doing a management interview or going out to the business. And as a result, I had a lot more information and I could tell the story of the company much better. So I was definitely at an information advantage. So don't shun the possibility of doing a management interview. The worst they can say is no and shut you down. But I would push hard on that because especially in specialty companies, niche businesses, there's no substitute for being on site and seeing what they do up close and personal. All right. That's the end of the decision tree. And I just want to do a brief discussion about consultants and experts. I'm talking primarily about financial consultants and experts. They are different, but they could be the same person. So I come into an engagement and thinking that I may or may not even be hired, but I'm wearing the consultant hat until the attorney tells me, usually officially, that I'm going to be the expert, the potential testifying expert. But I come into it always thinking, okay, I could become the expert, so I need to be careful with discovery, and I need to make sure that everything that I'm doing looks, in essence, I'm not giving the appearance of a conflict of interest, and I'm being objective. So that's the way I approach it. It doesn't matter which side's hiring me, I'm going to give it to them straight because, quite frankly, it doesn't do your client any good for me to tell a different story about the potential value of the business depending on who hired me. And I could become an expert later. So that's the way I approach this. But just knowing that you could hire a consultant that's more of an advocate. They could actually stay as a consultant and not become an expert, a testifying expert later. I think most of you probably understand this, but in the event that you haven't thought about this, if you're using a consulting arrangement, maybe it's cheaper, so to speak, but not every rock is going to be turned over. Okay, so you need to think about money left on the table. And if that consultant is really a stringent advocate, you might need to get a separate expert later, just to drive that point home. This is the question. Can the consultant be the expert? Well, if you don't break the objectivity, conflict of interest, et cetera, issues that I described before, if you're making sure you're keeping them on the level with regard to that. Does the client have a budget for an expert? And does that change if there's a lot of money on the table? So I'm going to get into discussion about ROI, or return on investment, which is an estimate that can help keep you on the path to how to best spend your money. It's the client's money, right? So you want to put them in the best position so that any money that they spend, if they spend any on a financial expert, that they get a return on that, if at all possible. Now, there are no guarantees, but I'm going to show you a way to do this so they can minimize their downside. How much could the client lose if the report is less than a full report or a conclusion of value? It's something to keep in mind as we go through this process. So this is just a little slide I put together on ROI, and just using the phrase "that's expensive." So that's expensive for an expert or a consultant is something that could be out there. You could hear it from a client. You as the attorney could say it, and you may be in fact correct. But let's gauge this in terms of return on investment, okay, or ROI. And these aren't, by the way, these aren't my fees, but the math is easy here. So I like to keep this easy math. And in some cases, my fees over a long, long period of time have been greater than what I'm showing you here. And in some cases, it's a shorter engagement and they were certainly less. But I'm just going to keep the math here easy. And so let's say that the client spent $20,000 in fees for the business valuation, meetings, and testimony. The business was valued at $1 million. The expert's report was accepted. It was split 50-50. That's what the judge decided after the judge said it was worth $1 million. They agreed with the expert's report. The client received a $500,000 allocation from the business, $500,000. The ROI was 25x. That was good ROI. By any measure, that was good ROI. You may say, understandably, well, Josh, that can't be guaranteed. I don't know what the judge is going to do. That is, in fact, correct, but it's better than guessing. And in essence, what I'm going to show you is a way to go through this on my one-page process where you can be reasonably comfortable that if your expert is good at what they do, that you're going to receive some level of return on your investment. Or you can stop. And I'm going to show you how to basically say, okay, this is not working. We're going to go a different route. And that's always acceptable. So let's go through an example where this turned out very poorly. Same amount of fees. The business was valued at $40,000. That report was accepted, split 50-50. The client received $20,000, half the 40, right? The ROI was 1x. Terrible, right? That was awful. And this is what I've seen occasionally in disputes where there isn't enough front-end analysis of the financial data and any negotiation. So they charge hard into the process, thinking that they've got a lot of value that they're chasing, and they're doing that with blinders on, and they're not really getting good advice. So be careful with this. The case that I'm thinking about is one where I was involved in where I was confident that the value, this shareholder was actually a minority shareholder, that their interest was worth probably about $100,000. Not a lot of money in terms of the likely tens of thousands of dollars of legal fees that they had spent on both sides. And by the time the case got to me, I looked at it and I went, this should have been settled. This case should have been settled long ago because there just wasn't a lot of money at stake. I want to stress upon you as the client's advocate, get some help and try to figure out if it's worth, what I like to say is the juice worth the squeeze? Okay. And find out if it makes more sense to negotiate this, because with an estimate of potential ROI with an expert, you could see likely that this could be the result early on if you do a document review and have some discussions. So you want to avoid these bad outcomes. So this is the one-page process that I think will work for most of your clients. And this is pulled off that decision tree, and we're going from the top left to the bottom right. So we're going across the top and then down to the bottom to the right. And you can see there are a couple of stop signs here where you as the attorney can say, okay, we're going to stop here. We're going to evaluate where we're at before we go on. So what I suggest in most cases be done is we get the financial records as is. We look at the tax returns and the financial statements. We find out, okay, this is a business generating cash flow, or the assets are greater than the liabilities. Spend a few $100s on a basic assessment of the business using the expert or consultant, and then get on the phone with them. And then these are some of the things that I talk about with the attorney. We can do Zoom screen share. We can do a phone call. I'm going to say, okay, Mr. or Mrs. Attorney, the sales look like they're doing this. The expenses look like they're doing this. The profit is doing this. The owner compensation, that is typically the W-2 out of the corporation, looks like it's this. What's the financial strength of the business, the debt load, the growth, the potential risk? And so I'm giving them my observations. And at that point, I'm also going to estimate a return on investment for a calculation report, with the goal being settlement. Again, for discovery purposes, we're very careful. We're not putting anything out there on paper. And at that point, you as the attorney can go, okay, we want to go ahead with that based on I see that you're going to pay for yourself here through some type of calculation report. Or you can say, okay, look, we're going to stop and we don't think we need this. And that either one is okay. If you proceed to a calculation of value, which I think is very beneficial in a lot of cases to get to settlement, you can go to the next step on the bottom in the center. And then if you want to, if it looks like, okay, this case is going to proceed to trial, settlement is off the table, then you can do that too with a conclusion of value report. So there's different places in this where you can stop. You can ask the questions. Does it make sense to go on and proceed, or stop? And I think this puts the client in the best position where their assets, their money, the marital assets are being used for maximum effectiveness, right? And so we're not spending their money unnecessarily, but at the same time, if there's a lot of money on the table, we're thinking about that too. This red arrow across from the left to the bottom right is unfortunately what I see way too often. So I see a situation where the attorney or the client, they say, let's go right to a report. Let's get a conclusion of value. And I push back against that because I don't think in a lot of cases, just skipping right to that makes a lot of sense until we ask these questions. Find out if the business has any value first. Do that, have those phone conversations, make sure it makes sense. If it's needed, yes, I can do that, but it may not make sense to go straight to it. I just see that way too often where they're skipping the questions and analysis, going straight to conclusion of value report. And that may very well not make sense. So here are some other considerations. These last two, I'm going to do a deep dive on. No slight to any business valuation credentials that I missed. I think I got most of the ones that I see on a regular basis here: the CVA, the ABV, the ASA, the CFA. Those are the ones I see most often. And I hope as an attorney or a business owner, you are using someone that has a business valuation credential or credentials plural. The ones here listed, all of them have business valuation standards that is written standards that provide a framework for issuing a proper and supportable report. Unrelated to that, just understand in my state, in Illinois, and there are other states too, I'm just speaking of Illinois right now, personal goodwill is not a marital asset. So typically what we're talking about here are, not always, but a lot of times we're talking about professional practices, could be doctor, dental, lawyer, CPA. There's typically goodwill of the business, intangible value above and beyond the hard assets. And then there is typically a carve out of that intangible value, total intangible or goodwill, for the personal goodwill that individual brings into that practice. That is not a divisible asset in the divorce, and that has to be estimated. I'm going to do a deep dive into cash flow. I talked about it earlier. I'm just going to really drive that home. Calculation reports in the courtroom, is this a good idea? So let's deep dive these last two bullets. What is cash flow? The simplest way to explain this is money that goes in the owner or owner's pocket after everything is paid. What most people think of as profit, and typically cash flow is a little less than profit, because there are things in the cash flow like principal payments on debt and needs for future working capital that reduce profit even down a little bit lower to the level where it's cash flow. It's one of the most important numbers in a business valuation. It's the numerator in the income approach. And the key thing, I mentioned this earlier, I think it's not shown anywhere on the tax return and most financial statements. So you can't find it because it's not a line item. You can't just pick up a tax return or a financial statement typically, especially since a lot of financial statements omit the statement of cash flows. So they may have one, but a lot of times they don't. So it needs to be calculated manually. And if you're not comfortable with that, reach out to me, because profit, especially from a tax standpoint, is often very different from cash flow. And one of the big changes between those is depreciation, which, if the asset is purchased using typical accelerated depreciation methods, so the business buys a big asset, a truck, a combine, something like that, it may actually not be an immediate cash outlay, but it may be a six-figure depreciation deduction. So the cash hasn't left the company, but the company shows a reduction in profit for that depreciation expense. So it's important to understand there is a difference between profit, especially from a tax standpoint, and cash flow, and reconciling those two, because valuation theory uses cash flow as the numerator, typically not profit necessarily. Profit is usually a little bit higher than cash flow. It's also important to understand that a tax return is a single purpose document. It's for the IRS. It's not for divorce. It's not for litigation. So it is structured to solve the IRS problems, not necessarily your problems. Cash flow is estimated on a forward-looking basis for business valuation. So let's just look at an easy example. So why does cash flow matter? If we keep the risk rate the same throughout these three examples, I say the business has $100,000 cash flow divided by a 15% cap rate, that's a $670,000 estimated value. That goes up to 150. Now we're up to $1 million value estimated. We get up to 200,000. Now we're at 1.340 million. So you can see this has a huge impact, and understanding what this is critically important, because you don't want your client leaving a bunch of money on the table. At the same time, and that would be sort of in an out-spouse situation. If you're helping the in-spouse or the moneyed spouse, so to speak, the owner of the business, you don't want them to, in essence, believe that the business is worth more than it is too, right? I mean, you want to make sure that they're not giving something away because they have a mindset that it's worth more than it is. You've got a different problem potentially depending on which side you're representing. Should use a calculation report in court. I think I've pretty much sort of let the cat out of the bag on this one, but this is something that I'm going to show you why I think this is typically a very bad idea. So this is straight from the NACVA standards, right out of them. A calculation engagement occurs when the client and the member, that is me, agree to specific valuation approaches, methods, and the extent of selected procedures, and results in a calculated value. So we're agreeing to limit the scope of the engagement to the approaches, methods, and the extent of those procedures. And so just to give you a real life example, we're going to do an income approach and a capitalization of cash flows method. That's all we're going to do. We're going to do that plus a market approach and a guideline transaction method. That's all we're going to do. No interviews with management, no detailed risk analysis, etc. And again, this can be a very helpful tool in settlement, but let me show you why this can be problematic in a litigation environment. This is required to be included in a calculation report. This quote at the bottom. This calculation engagement did not include all the procedures required for a conclusion of value. Had a conclusion of value been determined, the results may have been different. Okay? So if that doesn't put some fear into you as an attorney, it will when you see this. So this is what a cross-examination might look like. The attorney says, well, Mr. or Mrs. Valuator, you had the sentence above in your report. Did you do everything you would have done in a conclusion of value? And they should say no. So your answer might have been different if you prepared a conclusion, the attorney asks. Yes, says the expert. Is it possible the value could have been $500,000 lower or even $1 million? And the expert says, and this is the trap question, and I don't ever want to be in a situation where I have to answer the question like this. And this is not a great answer, but let's assume this is the answer they gave. Yes on 500,000, no on $1 million. So they're saying, okay, no, it's not possible. It could be $1 million lower. And the astute attorney goes, well, how did you know the value couldn't be $1 million lower if you didn't do all the work? And then that leaves the expert stammering. And the attorney says, why should the court rely on your report? And this is a really bad day, right, for the expert and for the side that hired them. So you don't want to be in the situation. So this is how I use calculation reports. I use them for litigation settlement. Be careful what you put in writing. In Illinois, draft reports are discoverable. I can't speak to every jurisdiction, but they can get pulled in. I had this happen to me. I made a mistake. It wasn't a business valuation engagement, but I was in a situation where there was a really tight timeline. I put together a couple of draft reports. As it turned out, because I was completely objective and transparent, it did not hurt the client. And in fact, it was actually more beneficial to the other side as more information was gathered. I had gaps in the information that I had available. Generally speaking, I mean, do not suggest draft reports in jurisdictions where they could get pulled in. And some, that's not the case, but just be careful with that. And calculations, again, I like on the laptop with the attorney in their office, sometimes with their client, sometimes not, depending on what the attorney likes to do. And or I'm doing a Zoom screen share, which is really helpful because the case could proceed to trial later. And then we've got this draft report hanging out there, which could be very destructive to your case. Because think about a situation where I'll give you an example that I run into a lot. Let's say I prepare a report for settlement and I don't ask a lot of questions about management or the process by which they generate revenue. I don't know much detailed about the customer base or anything like that. Well, then I go out to the business and I see things that really make me think that there's a lot more risk there than I thought. There are apparent safety issues. There are customer concentrations. They have one customer that's 90% of their sales. Now, suddenly I'm thinking about this business much more differently than I did when I was doing a report for settlement where I didn't ask all those questions. So when to consider settling, a lot of these are out of the decision tree and a few others as well. If it's a job, not a business, if there's no cash flow, if the liabilities are greater than the assets, if you as the attorney, you're out of time, there's bad return on investment on a conclusion of value. It looks like this is a losing situation. A conclusion would cost X, 5 figures potentially. The value of the business may be $20,000 or $30,000 or something like that after having some discussions with the expert. What happens if you burn up the phone trying to find experts, but they're all booked solid? You may want to consider settling in that case. What if the budget is not big enough for both forensic and valuation work? We've got a real mess. They haven't filed tax returns for 10 years, and you really need some forensic work done, but you've asked for funds from the court to request funds from the moneyed spouse to do forensic work. The judge says no, and you're stuck. So you've got to find a path through. And so settling, think about that. The other side's not going to hire an expert or consultant, and they'll take your phone calls and meetings. Okay, so these are situations where it very much makes sense to think about settling. How about when to consider not settling? The other side is coming with a conclusion of value. They're leading with that. They're going to hire a well-known expert with a good reputation. There's big money at stake, and they're not taking your phone calls or your meetings. Now, this is a situation where you see the German Shepherds down below having a fight. You could be in for a dog fight. So roll up your sleeves and you could be in for a fight. So whether you're settling or not settling, what I suggest is prepare for the worst case scenario early. I cannot stress this enough. A lot of situations I've run into where they run out the clock and everybody's got a lot on their plate. I understand we're really, really busy, but try to spend that time on the front end. Spend an hour or two figuring out if this client walks in and they own a business and they're your client, or you know that the spouse on the other side has a business, spend some time to figure out, okay, I always ask myself this, this has been one of my favorite CPA questions over the years. I always ask myself, what's the worst thing that could happen here? Okay, if you ask that question early, it will prepare you for the downside. So here are my parting thoughts on this. A quick yes or no to a business valuation will hurt your client without going through this process. This relatively simple process and decision tree, I think, will get your client in a better situation. So there's my timer. I'm down to the wire here. I'm about done. Work the decision tree and the simple process early. I already pretty much said that in the prior slide with the atomic bomb. A no on a conclusion of value doesn't mean no analysis. I've showed you some ways that you can do that. You can still have an expert or a consultant look at the documents and see, okay, I see that this business is growing or it's shrinking, or and this is, I mean, have those phone conversations that I showed on the one page process that had the arrows on it. If you're uncomfortable with numbers, and that's okay, it may not be your thing, find someone who is. A good expert should pay for themselves by estimating ROI. Now, the pushback here, and I understand you may say, Josh, we have no idea what the judge is going to decide. And I get that, but it beats guessing. I can't guarantee, but what I can do within a reasonable range is I can say, okay, the value of the business is probably between X and X, assuming the information that we have now. Now, if the information changes or if there's something that we don't know about, it could change, certainly. But I like to establish the high and the low and have that discussion with the attorney early, if at all possible. And the smart attorneys I've dealt with, and I've dealt with some really smart ones over the years, they will do that early on in the process because they're thinking, okay, can I negotiate? And they're also thinking, okay, what's my downside risk to my client here? Find out what can be done with the time and the dollars available. Understanding the cash flow of the business is critical. Recall the $50,000 increments and what a big impact that can have on value. Calculation reports can be helpful if handled carefully. Great for settlement. And don't take settling off the table if the numbers make sense. I really appreciate your time, and I'll get this recorded and out. If you have colleagues that want to see it, I'd be happy to send it to them. My contact information, you can take a look there at that. And if there are any questions, I'll take those. If not, I can let you hit the road. I really appreciate it. I'm also open to any constructive criticism. If there's anything here you think that I thought about the wrong way or ways I can improve this presentation, please reach out to me because this is what it's about. I want to get your input, your questions, your comments so that I can make this better so we can all get better results for our clients.